Hey, what's up guys? It's Shafe. I wanted to do a really quick video on mortgages for those of you who are interested and maybe learning a little bit about mortgages. Um, I'm just going to do a short tutorial. I'll try to keep it as short as possible. And I'll try to keep it as simple as possible as well. When I'm learning a new concept or a new business, I prefer to learn things in large, simple chunks and then sort of break it down from there and get more and more specific in future lessons. So the first lesson in Mortgage 101, now hopefully most of you guys know what a mortgage is. We're not going to get to that basic fundamental. I'm not going to go into what is a mortgage and stuff like that. You should already know what a mortgage is if you're watching this video. But anyway, I want to break it down to three main pillars of getting approved for a mortgage and knowing what you need on each of those pillars to get approved for a mortgage. Okay, and so the three main pillars are what we call DTI, LTV, and credit score. Now the first two may be unfamiliar terms to you, but the third term should obviously be a familiar term to you. Most people understand what a credit score is, and most people understand that they have a credit report and they have a credit score. I don't think everybody understands the difference between a good credit score and a bad credit score, or maybe a so-called mediocre credit score. But I have written loans and underwritten loans and about 3 or 4 different mortgage companies. So I know from experience that typically, not always, but typically, the minimal credit score that you want to apply for a normal type of a loan is 620. If you have a credit score that's under 620, you're typically going to have problems getting approved for most of the programs out there. If you're at 620 or above, you'll get approved for your standard basic programs. Now another tier, if you will, in credit scores is 680. Once you hit the 680 mark, typically, and this was before the subprime blow up, typically you could qualify to get cash out of your home. You could qualify for less money down when you bought your home, stuff like that. The next tier is 720. Typically, if you have a 720 credit score or higher, you will qualify for 95% of the programs that are out there. Some really conservative banks like JP Morgan Chase will require a 760 credit score, among other things. They'll require a 760 credit score to qualify for certain things. But 720, you're pretty much going to qualify for just about everything out there, provided that your DTI and your LTV also match up. So let's get into those sort of maybe possibly unfamiliar terms to you guys. Okay. DTI and LTV are both ratios, okay? So it's going to be one number compared to another number. So DTI stands for debt to income. So, and it's very simple. It's your debt compared to your income. So if your debt is $2,000 a month and your income is $4,000 a month, then your debt is 50% of your income. It's very, very simple, okay? So I'm trying to keep it as simple as possible for you guys in this first tutorial, okay? So just remember debt compared to income. And the next one is our LTV ratio, which is loan to value, okay? So once again, it's a ratio, and it's your loan amount compared to the value of your property. So if your property is valued at $100,000 and your loan amount is $80,000, then your loan to value ratio is 80%. If your loan amount is $50,000 and the value of your house is $100,000, then your loan to value ratio is 50%. Now, as you can imagine, LTV and DTI, the lower the better, right? So if your debt is a lower percentage of your overall income, that means that you're typically going to be in a better position to pay back your debts. Now, it's important to point out here that when we're talking about DTI, your debt to income ratio, we're talking about your gross income before expenses, everything. It's the gross amount on your paycheck or your tax returns or whatever. It's so interestingly, like when I got into the mortgage industry, I remember raising my hand and saying, well, why don't they look at your net? Because your net is your actual take-home pay. And the answer is, we just don't. And so that's going to be the answer to a lot of questions that you guys might have about certain things when it comes to mortgage underwriting. But for now, they just don't. And it's also important to point out that the debts that they're looking at are actual loans that are going to show up on your credit report. So any credit cards that you have, that's called revolving debt. Any auto loans that you have, any mortgages that you have, if you have other properties, right? That means we're not talking about your electric bill. We're not talking about your groceries. We're not talking about your phone bill. We're not talking about things that aren't actually considered debts. They're more like bills, if you will, right? You can cancel your phone. You can buy cheaper groceries. But if you've got a car payment, you can't just cancel your car payment, right? Unless you pay it off. So it's important to distinguish debts from bills in this scenario. So I hope I'm not making it too complicated, but I think there's some important distinctions to make there. Let's get into LTV a little bit more, okay? LTV is huge. Now, the difference between the loan and the value is what we refer to as equity, okay? So going back to my first example of loan-to-value ratio, you have a loan amount of $80,000. You have a value of your home, which is determined by an appraisal, to be $100,000. So how much equity do you have? $20,000, right? So it's the remaining percentage. So you get your loan-to-value ratio, and then the remainder is always your equity. Now, some people, unfortunately, in this environment, have negative equity, right? You're literally upside down. Like I'm sure a lot of us have been upside down on a car before. If you bought your home in 06, 05 even maybe even 04, you might be upside down on your house, okay? So you've got a loan-to-value ratio that's over 100%. So you've got a loan amount of $80,000, and we send an appraiser out to your house, and he appraises the house for $65,000. So you owe $15,000 more than the value of your house. Now, typically people like that are, especially if they're having trouble making their payments, they're going to call up their bank and try to modify that loan, but bank won't always do it for you, but it's an unfortunate situation, obviously, right? But that's just to show you that a loan-to-value ratio can be over 100%. Now, sorry to jump back to debt-to-income ratio. DTI, it is important to talk about what is an acceptable debt-to-income ratio. And for most banks, being conservative, the line in the sand, if you will, when you're talking about debt to income ratio is 45%. Okay, so if you're making 10 grand a month, you want your expenses to be 4,500 or less. Now, to be a little bit more realistic, say the average person out there is making 5 grand a month, right? So then you're talking 2,250 in expenses, and that's all your expenses, and that's taking into consideration the loan that you're asking for, right? So if you want your expenses to be at $2,200 or less, and your new mortgage is going to be $1,000, well, then your current expenses need to be $1,200 or less because you're going to be adding $1,000 to that. So when the underwriter looks at what's going to be your debt to income ratio, they're throwing in the mortgage with that, included with that, right? LTV, credit score, and debt ratios. Those are the 3 biggest pieces to understand. So once again, minimum credit score, you probably want it to be 620. If you have a credit score under 620, there are ways you can fix your credit. Just talk to your bank, call Equifax, Experian, TransUnion, the 3 credit bureaus, and see what you can do to raise your credit score. Your debt ratios, you want them to be at 45% or lower. And for an LTV, you really want 80% LTV or lower. Now, a lot of people don't have 20% to put down on a house when they buy it. That's when you get into mortgage insurance. If you have less than 20% to put down, and we'll get into closing costs and prepaids and all that other stuff in another video. But I'm gonna wrap it up here. So talk to you next time. Hope this helps some of you.